Making money in a falling market isn't just profitable. There's a unique satisfaction in executing a flawless trade when the rest of the crowd is panicking. And with the right system, that can absolutely be you. This is part 1 of a 5-video short selling module where I'm going to teach you exactly how to find a short sell candidate, execute the short sell, and safely profit on the way down. Let's begin our short selling framework by defining the exact characteristics of a high probability short candidate. First, late stage consolidation. Counterintuitively, the absolute best short sell candidates are often the stocks that have gone up the most in price during the preceding bull cycle. As these market leaders advance, they tend to form consolidating bases, going sideways for 5 or more weeks on multiple occasions. We want to strictly focus our attention on stocks entering their third, fourth, or fifth consolidation patterns. By this stage, the institutional buying power is exhausted, making the structure incredibly fragile and prone to a massive distribution breakdown. Second, overhead supply. Our second primary candidate is a stock that has already suffered a major technical breakdown and is now experiencing a reflexive rally back up into an area of overhead supply. As the price bounces into this resistance territory, trapped buyers who bought near the top will rush to sell just to break even, creating a massive wave of technical selling pressure. Remember, short selling is purely technical discipline. You cannot wait for the fundamentals to justify your trade. Often, long before a company's balance sheet or earnings report show any visible flaws, the price action and volume footprints will tell you that the smart money has already determined something is fundamentally wrong. We follow the price, not the narrative. First, let's discuss late-stage consolidation in more detail so you can understand the life cycle of a market leader. Stages 1 and 2, the sweet spot for buying. Whenever major market trend begins and the regime shifts from bearish to bullish, leading stocks will break out from their first consolidation base. As they advance in price, they will inevitably pause and consolidate a second time. These first 2 stages represent the sweet spot for long traders. They are structurally most reliable and highly profitable bullish patterns. Stage 3, the tipping point. If the general market remains healthy and a stock is fundamentally sound, perhaps delivering strong earnings surprises, it can break out from third stage and succeed. However, stage 3 is a critical tipping point. The pattern becomes inherently more risky, institutional sponsorship begins to fragment, and the probability of failure rises sharply. Stages 4 and 5, the maturity phase. By the time a stock enters its fourth or fifth consolidation base, the upward move has become completely obvious. This is the maturity phase. The general public finally notices the stock and rushes in due to FOMO. But the smart money is already looking for the exit. At this point, the trend is entirely exhausted, and these late stage bases almost always fail. The sought opportunity. This structural exhaustion is exactly where our edge is born. Once a stock has extended into these late stage bases, we stop looking to buy the breakout. Instead, we place them at the top of our watch list and closely monitor them for structural weakness, distribution, and the ultimate breakdown. The second type of stock we must carefully monitor are those rallying directly into heavy overhead supply. The setup and rally. After a stock completes a late stage third, fourth, or fifth consolidation base and suffers a major structural breakdown, it will typically fall rapidly. However, at some point, the asset will experience a reflexive rally, bouncing back up toward the previous distribution zone. The resistance. This zone represents an immense wall of overhead supply. Think about the psychology here. Buyers who bought at the absolute top of that earlier late stage base are now deeply trapped in losing positions. When the price rallies back to their entry levels, these trapped buyers experience an emotional sense of relief. They rush to exit the stock just to break even or minimize their losses, creating an immediate wave of technical selling pressure. The edge. If the new buyers cannot overcome this heavy wall of sellers, the rally will stall, roll over, and the stock will once again crash below its 10-week moving average. This breakdown below the 10-week line marks our precise short sell entry point, the 18 to 24-month rule. However, timing is critical when measuring overhead resistance. The psychological pressure from trapped buyers diminishes significantly after 18 months, and it vanishes almost completely by 24 months. This means for this edge to remain valid, the overhead supply zone we are targeting should be under 18 months old. Any older, and the memory of those trapped buyers fades, reducing the technical probability of a clean rejection. So far, in this video, we have covered exactly what kind of structural characteristics to look for when building a short watch list. Now let's talk about the specific filtering process that moves the stock from a broad scan onto your active radar, the alert. As a stock moves up and exhausts its post cycle, you would typically look for a high volume breach of its 10-week moving average, following a late stage, third, fourth, or fifth consolidation phase. This sudden violation of a key long-term moving average on heavy institutional volume is your primary alarm bell. The action. The moment you witness that 10-week moving average giveaway, you immediately place that stock into your active short sell watch list. But let me emphasize the absolute golden rule of systematic trading here. Do not short the stock right here. Patience is the key. Seeing the initial evolution is simply your indicator to add the asset to your watch list. This is the time to track, observe, and stock the step up as it develops, not to chase the big down day in a moment of FOMO. We want to act with complete emotional neutrality, waiting patiently for the precise technical entry we will discuss in the next video. Now, let's dive into a piece of critical data you must analyze before ever pulling the trigger on a short position: tracking short interest trends during the pre-entry build-up phase. Counterintuitively, we want to see the stock's short FOB, meaning the overall monthly trend of shares shorted, and a clear long-term downtrend leading directly up to our entry point. This tells us that earlier short sellers have already been steadily covering and exiting their positions. Why is this an absolute requirement for our edge? It completely removes artificial buying demand from the equation. When a stock's short interest is highly crowded and actively rising, it creates a technical powder keg. The moment a minor bounce occurs, a massive cluster of weak, impatient short sellers will be forced to panic buy the stock back to cover their losses. This forced buying creates a violent, artificial rally. By demanding a downtrending short food, we ensure those impatient shorts have already washed out of the market, heavily mitigating the risk of a sudden short covering squeeze. This criteria is an absolute deal breaker for a systematic trader, and it is exactly where unprincipled traders get caught. Take a look at this example with SCHW, Charles Schwab. On the chart, it met almost every single requirement we have discussed for a stock failing structurally from an area of overhead supply. It looked perfect. However, because its short float was aggressively increasing during its build-up to short entry, the setup completely failed. The crowded short interest provided the exact underlying fuel the market needed to spark a massive squeeze against the late shorts. Never skip this step. Check the underlying short data, ensure the artificial demand is gone, and protect your capital. You can use Finviz, FIMVIZ.com, search for the ticker, and click Short Interest tab. You'll find the multi-month short interest data right here. Another critical criteria before shorting the stock is checking its 50-day average volume. You want to see at least 1 million shares traded per day. To check this, simply pull up your daily chart and look right at your volume moving average line. You'll be able to clearly see the current number there. Here's why that matters. If liquidity is too low, the price becomes incredibly erratic. A single large firm deciding to buy can instantly create a massive spike in price, forcing a violent short squeeze. Keeping that 1 million share baseline ensures there's enough liquidity to make the ride smooth. Before we wrap up this first video, let's look at few real-time examples. Here are a few prominent stocks that have already formed fourth and fifth stage bases during the prior bull cycle and are actively flashing structural weakness as I prepare this tutorial. Full disclosure, I currently hold short positions in these names. To help you study these structures on your own, I have shared a link to all the charts discussed in this video in the description below. Feel free to download, review, and map them out on your own screens. In the next video, we are going to dive into execution. I'll teach you exactly how and when to monitor a stock after its initial structural breakdown and precisely how to time your short entries. Make sure your charts are prepped and study the downward links. I'll see you in the next part.